Many people dream of achieving early financial freedom through passive income. They pursue various passive income ideas inspired from their friends or social media, but rarely consider an overall strategy. In this video, I'm going to explain why the passive income ladder strategy is the fastest way to $1 million and how it can help you decide which passive income ideas to pursue. The passive income ladder consists of 3 levels. The first level is active income, which virtually all of us start off with. Passive income makes up the second and third levels. There's depreciating passive income, or DPI, and there's appreciating passive income, or API. Your goal should be to transition your income source from active income to DPI and ultimately to API. It's critical you understand their differences, so let's unpack this one by one. Active income is simple. It's any income that you earn that is directly tied to the time you spent working for it, whether you build a product or provide a service. This includes any traditional job where you are paid by the hour or a salary, but it can also include non-traditional jobs like working as an Uber driver or a freelancer. Active income has 2 disadvantages that make it hard to build wealth, but it's the only income type many people have. The first downside is it constantly requires your time and effort, and the moment you stop, the income stops. But more importantly, there's a hard cap on how much you can earn, because obviously you can only work up to 24 hours a day. Even if you're paid by commission, you're physically limited in how many sales calls you can make, for example, or how many clients you can take on as a freelancer. Also, taxes are the worst for active income. As shown here, you pay some of the highest tax rates in the revenue code for active income, starting with the very first dollar you earn, from 10% to as high as 37%. You also need to pay FICA tax on top of these for Social Security and Medicare, and we haven't even started with state and local taxes. But to add insult to injury, if you earn active income as an employee, most of the best strategies to lower your taxes, like expense deductions, S-Corp elections, and depreciation, are off limits to you. Now, DPI has huge advantages over active income, and you might be considering some of them, like selling a digital product, building a dropshipping business, creating an online course, or starting your very own YouTube channel. All these require a ton of effort and work up front when you start them, but once they are up and running and with varying degrees of follow-up work, they literally make you money while you sleep. Unlike active income, your earnings with passive income is not directly related to your time. This is because you yourself are not the product or the service provider like when you work for active income. Instead, you create a distinct asset that people get value from, and that asset as the product or service earns you income passively. But there's 2 huge underappreciated implications regarding this. First, there's no limit to how much you can earn with DPI because of the explosive scalability potential of the assets you create. For example, if you write an amazing ebook and publish it online, there's no limit to how much you can earn. There's minimal upfront cost, no inventory to manage, no distribution constraints. You could write and upload a book in a week, and it could potentially earn you $1,000 or $100,000 or even $1 million over time. But there's more. The best DPIs have what is known as the conglomeration effect that multiplies your passive income streams and magnifies your income potential. For instance, many YouTubers earn income from their channel in multiple ways. They can earn income from ads on their YouTube videos, from affiliate links through product promotions, from brand sponsorships, and even their own digital products. All these passive income streams can be deployed in concert with a single YouTube channel and benefit from the explosive scalability of the channel itself. But DPIs have 2 big problems, and this is why there really is no such thing as the one best passive income, because all passive income sources have strengths and weaknesses. The first weakness of DPIs is that they are taxed just like active income at ordinary rates. You can be taxed as high as 37% and have to pay the full 15% Social Security and Medicare taxes as a full-fledged business. However, the silver lining is that unlike active income earned as an employee, you have at your disposal more strategies to reduce your taxes because you run a business. But DPIs have another problem that is much more consequential. It might not be at the top of mind when you start building a so-called DPI asset, but the reality is they lose value and won't last forever. No matter how good of an ebook you publish, its value will slowly depreciate over time as newer and better books are published. The same is true of assets like YouTube channels, online courses, and drop shipping businesses and others. You have to continuously maintain, improve, and update them with current trends and new value propositions. But they also lose value in ways beyond your control. You might have heard the term creative destruction. It's an economic term that refers to the incessant product and process innovation mechanism by which new production units replace outdated ones. The things we find innovative and indispensable today are likely to be replaced and become obsolete in 10, 20, 30 years. There will come a day when TikTok, iPhones, YouTube, you name it, it could all disappear like horse-drawn carriages and floppy disks because of new ideas and technologies. Even the internet itself could change in ways we can't imagine. The bottom line is there is no guarantee that the DPI you have today will provide income for you in the coming decades. There's a good chance it won't. So if you want financial freedom that will stand the test of time, you have to turn to appreciative passive income. Unlike the others that require some combination of time and effort, the only input required for the most part for API is money. For the vast majority of people, API involves investing in stock and real estate assets. Assets that have been around for generations and have been the best means by which people secure and grow their wealth for the long term, whether that's through appreciation or dividends and cash flow. To give you some context, this is the Dow Jones Industrial Average since 1896, the oldest stock market index in America. For 125 years, the index has risen from a mere 40 to nearly 35,000 as of this recording. That is a staggering 87,500% increase. Over that time, there have been over 20 market panics and recessions, including the Great Depression, 3 major pandemics, 2 world wars, and 1 like button waiting to be smashed. Yet over the long term, the Dow index and the overall stock market always appreciates. So you need to own a piece of that appreciation to secure your financial freedom. The great news is you don't have to know much about the stock market to get a piece of the action. The most important thing is to invest early and often with any extra money from your active or passive income, so that your money compounds over time. The most passive and successful way to invest is to buy an S&P 500 index fund like SPY, which makes you an instant stockholder of the 500 most productive and profitable companies in the world. So if you want to start investing with SPY or other index funds, to help you get started, M1 Finance is offering $30 for opening an account and depositing $1,000. M1 is an online investing platform built for passive investors. It is commission-free, no minimum deposits, there is no cost to use the basic service. So you can try it out and get free money just by signing up and making a deposit. So start investing now by using the link in the description, and by doing so, you also help support this channel, so thank you. So to bring everything full circle, let's say you want to achieve $1 million in net worth. Each rung of the passive income ladder can be ranked across 4 qualities to chart the fastest path to 1 million. The first quality is initial effort, as in how much work does it take to start making enough money to live on. Active income by far requires the least effort. You can get a job tomorrow and quickly start paying your bills. The second quality is how much can you potentially earn. DPI dominates this quality because it has the explosive scalability potential that active income and API does not. Again, active income is capped by your time, and API can only grow so much without taking on too much risk. But with DPI, the income potential is limitless, so you should try as many passive income ideas as you can handle because you only need one to succeed. The third quality is how to secure and grow your money as you build up to 1 million. API wins this quality hands down. The most enduring assets you can own are stocks and real estate. They secure your wealth and can grow it over the long term at a rate nothing else can match. The fourth quality is about paying the least amount of taxes to get to 1 million. And again, API wins this as well. When you hold stocks and real estate long term, any realized gains are usually taxed at much lower rates shown here. These are the long-term capital gains rates on the left compared to these ordinary income rates on the right. And remember, DPI does open up some tax strategies, but you're still taxed at ordinary rates. So based on these qualities, arguably the fastest path to 1 million is to move from active income to DPI as fast as possible. Instead of doubling down on active income like working harder at your job in the hopes of getting a raise or working a second job, redirect your time and effort towards building DPI assets. You have to break the cycle of trading your time for money in order to grow your income exponentially. Once DPI provides you enough income to live on, You could choose to reinvest your money into more DPI or start investing it into API such as stocks or real estate. Then once you start investing in those, your money will grow on its own, making it much faster to reach 1 million without more time or work required on your part. You can certainly invest in APIs while you earn active income, and you can earn active income while you also have DPI. My point isn't to prescribe when these income levels should overlap or how the transitions would work for your personal situation, but really about how the leveling up of your income through the ladder strategy accelerates your path to financial freedom, however you choose to do it. Now, the value of this ladder strategy isn't just to outline some concepts, but it helps you consider what are the best passive income ideas you should pursue, because it focuses on the end goal. How you envision spending your time once you reach financial freedom determines how you should approach API and what role DPI will play. I would argue your life of financial freedom could fall between two opposite spectrums. On one hand, you might want absolute financial freedom, as in you never want to work ever again, and passive income, specifically DPI, is a means to an end. On the other hand, you might enjoy working for passive income and want to continue, so DPI is both a means and the end. In this case, you just want enough financial freedom to not have to work for money. If you lean more towards wanting absolute financial freedom, then building up your API is your top priority so that you can quit your active income and also no longer have to work on DPI. This would require you to focus your investments on growth-oriented stocks and real estate to aggressively grow your API so that you can cover all your expenses at a 4% withdrawal rate. So if you need $40,000 to be totally financially free, then you will need a $1 million investment portfolio. The 4% withdrawal rule comes from several studies that back-tested different portfolio withdrawal rates and found 4% to be safe, but with several assumptions that you should be aware of. I'll link to an article below if you want to learn more. Now, in this situation, DPI is really a means to an end, namely to invest in API as much as possible. So you'll want to focus on DPIs that have strong conglomeration effects and build out as many income streams as you can, all the while investing as much money from those into stocks and real estate. However, you might be spending as much time working on all these passive income projects as if you had a full-time job. If you prefer a better work-life balance scenario, then you might lean more towards the other end, where you enjoy work and staying productive and you want to continue working even if you don't need the money. In this case, your top priority is finding and building DPI that you are passionate about and that may even lead to pursuing some active income opportunities like consulting or coaching work. You might also prefer focusing on a few DPIs that align with your passion and interests instead of chasing after every opportunity. Your approach to API might also be different as well, where you might want to prioritize investing for income, like with high dividend stocks and ETFs, so that it might help you better maintain a work-life balance. If you found this video valuable, be sure to hit that like button down below, subscribe to the channel, and hit that notification bell so you don't miss out on future videos. Thanks for watching, and I'll see you guys at the next video.